In the past week, several important financial markets, including the market for U.S. Treasury securities, have at times shown signs of stress and impaired liquidity. The market for Treasury securities is a critical part of the foundation of the global financial system. It is generally the most liquid of all markets and serves as the benchmark by which many other financial assets are valued. It plays an important role in allowing households and firms to earn a safe return and manage their risks. When stresses arise in the Treasury market, they can reverberate through the entire financial system and the economy. To prevent this from happening and to support the smooth functioning of the Treasury market, we announced today that we will purchase at least $500 billion of Treasury securities over the coming months. Similar stresses have also emerged in the market for agency mortgage-backed securities, which is closely linked to the Treasury market and critically supports the ability of people to get a mortgage, to buy a house, or refinance an existing mortgage. To improve the functioning of this market and to ensure the effective transmission of monetary policy to borrowers in the economy, we will also purchase at least $200 billion of agency mortgage-backed securities over coming months and immediately cease the runoff of these securities in our portfolio. While the primary purpose of these securities purchases is to restore smooth market functioning so that credit can continue to flow, the purchases will also foster more accommodative financial conditions. The Federal Reserve announced a number of other actions today to support the flow of credit to households and businesses, thereby promoting our maximum employment and price stability goals. Of these, I will highlight two. First, we reduced the interest rate on discount window loans by 1.5 percentage points, bringing that rate to 0.25%. The discount window plays an important role in supporting liquidity and stability in the banking system, and we encourage banks to turn to the discount window to help meet demands for credit from households and businesses. To make the discount window more effective, we will also offer discount window loans for periods up to 90 days. Because of the importance of the U.S. dollar in the global economy, strains in markets for borrowing and lending dollars overseas can disrupt financial conditions here in the United States. To guard against such disruptions, the Federal Reserve maintains swap lines with 5 major central banks. When dollar funding pressures emerge abroad, those central banks can contain the pressures in their jurisdictions and prevent them from impeding the flow of credit here at home. To address potential pressures in these markets during the current period of elevated uncertainty, we made a coordinated announcement with the Bank of Canada, the Bank of England, the Bank of Japan, the European Central Bank, and the Swiss National Bank to reduce the pricing on our dollar swap lines. In addition, our central bank counterparts will begin offering dollars to institutions in their jurisdictions for a term of 84 days, in addition to the usual 1-week operation. These long-standing arrangements carry no risk to the Federal Reserve or to the American taxpayer. I won't go into detail on the other actions we took today, but they involved eliminating reserve requirements for banks and encouraging banks to make use of intraday credit with the Federal Reserve and to use their capital and liquidity buffers as they support lending to households and businesses. The actions we have announced today will help American families and businesses, and indeed our entire economy, weather this difficult period, and will foster a more vigorous return to normal once the disruptions from the coronavirus abate. We will continue to closely monitor economic and financial developments and their implications for the economic outlook. We are prepared to use our full range of tools to support the flow of credit to households and businesses, to help keep the economy strong, and to promote our maximum employment and price stability goals. Finally, let me note that today's FOMC meeting was in lieu of the meetings scheduled for next Tuesday and Wednesday.